So the biggest thing here and the most important thing is that the worst thing that can happen is you lose your premium. Hi everyone, so I have talked in detail before about selling put options because that is something that I do when buying into a position. I've also done a video on buying put options and selling call options. So today I'm going to round out that series by talking about buying call options. Now there are a lot of really complicated option strategies out there, but today I'm just going to keep it really simple and just focus on buying the call options. What it is, when to use it, if it's a good idea or not, and then a demo on how to execute it yourself if you want to. All right, paiehole. So buying a call option is when you agree with someone that you may buy a certain stock in the future at a predetermined price. Let's say Alibaba stock is at $130 and you think the stock might move up. So you want to still have the option to buy 100 shares at that $130 mark in 6 months' time. So you buy a call option that will expire in 6 months' time at $130. Now for this luxury, you might have to pay, say, $300 for the contract. So let's see how that might play out. So the first thing is that the stock price might move higher than $130 over the next 6 months. Well, you then have the option to buy the Alibaba shares, but at $130, even though the share price might now be $160. That's pretty great because you're buying shares and instantly making a profit. You did pay $300 for this luxury though. Then there's the other scenario where the stock price stays the same or goes lower than $130 over the next 6 months. Well, you can't lose any more than the $300. So you just let the option expire and don't execute it, taking the $300 loss. But what if you actually just bought the stock instead of buying the call option? Well, you would get the exact same result as option one by having the price increase in your favor from $130 to $160, but you just didn't have to pay that premium. So you're $300 better off if you just buy the stock. But if you bought the stock at $130 and it went to $110, well, you would have lost about 15% instead of just the $300 premium on the call option. So the call option actually protected your downside in scenario two. So buying a call option is kind of like just buying the stock, but you're buying the right to buy the stock in the future. So essentially you are hoping the stock price moves up, but you would be protected if the stock price moves down dramatically. The other big benefit is that you can participate in the increasing stock price without ever actually owning the shares. Maybe the shares are, I don't know, too expensive, like Amazon shares or something. And to do this, you can just cancel the contract before expiry and take a profit on the contract if you wanted to. But honestly, I'm not familiar with anyone who has been able to buy call options in an effective way. I think it's more of a trader's tool to gamble on the stock prices. But I guess one way to look at it is that it is like paying insurance. If the stock tanks, well, you only lose a fixed amount. If the stock stays the same, you still lose that fixed amount. But if the stock takes off, well, you can buy the stock at the cheaper price, but of course you still pay that fixed cost. So the only advantage I see is to do the strategy if you don't have much money and you really want it to be invested in a particular company. Maybe you don't have the cash right now to buy 100 shares of Alibaba, but maybe in a year's time you will. So you could pay the premium now, and if the stock moves up and you earn more money in your life, then you'll be able to purchase the stock at the price you wanted. But then there's this real possibility that you just lose that premium. You would have to be really, really bullish on the stock and have enough time to allow the stock market to price the stock correctly higher. And a stock can easily trade sideways for years, even if it is a good company. So it might be better to just buy a smaller amount of the stock rather than trying to chase 100 shares. I mean, if the premium costs $1,000, but to simply buy 100 shares was only going to cost you $5,000, well, that is just like taking a 20% loss immediately. And compare that to if you were going to buy the shares anyway at $5,000 and the price stays about the same, well, you don't lose anything. You still have your stocks worth $5,000. So in that scenario that I just explained, you actually buy the call option and you lost $1,000 more than just buying the shares. So the biggest thing here and the most important thing is that the worst thing that can happen is you lose your premium. You can't get wiped out if you do this correctly. So maybe this is something for you. I don't think it is for me because I don't like paying the premium for something I already wanted to buy. But I can see the appeal for those who don't have the money and want to invest in a particular company that they understand really well. And if you are interested, let me now quickly show you how to do it. The platform I'm going to be using is called Interactive Brokers, which is the platform that I use personally and I highly recommend here on this channel all the time. It's the best for options, doing these options and long-term investing and things like that. There's a link in the description below if you want to take a look at a demo account and try it before you buy. Having a good broker that gives you access to international markets is really important. And I think it's just as important as any investment that you're going to make.
Okay, so I'll do the demo here on buying a call option quite quickly. So I'm going to go to the options chain. I've got Alibaba as the stock that I'm looking at the moment. And I've just gone to the options chain. The market's not open at the moment. So this is what it looks like when the market is closed. See, it says C 27.34, all the C's. It means that was the last closing price. So, okay, let's have a look here. These numbers here that I'm looking, I'm in the call side, and I've got the date to be about a year away. Now I'm going to. This is the premium that you're going to have to pay, $27.34 per share, and you got to pay 100. You got to buy 100 shares essentially. So this is actually $2,734 would be the premium at a strike price of 130. So that means in a year's time, I would have the option to buy shares at $130 a share. But for that luxury, I have to pay $2,734. Okay, so not only it would make no sense, even if the stock price was at 140, well, that's not really, I can make $10 per share, so I make $1,000, right? But I had to pay $2,700 for that option. Therefore, I lost money. Hence, the stock actually has to move quite a long way. So how I'd calculate it is, well, it's 130, 2,734. So it's got to go up essentially $27.34 above 130. So that would be nearly 160. Once it goes past $157.34, well, then it starts to be a profitable trade for me. So it has to go from 131 to 157 in a year's time. I have no idea if that's going to happen. Of course, we're just speculating here. So I don't really like doing this because I think it's speculating. I would prefer just to buy and hold, and if it takes 5 years to go up 100%, great. I just don't know what's going to happen in 1 year's time. I think there's a lot of ups and downs that can happen, but I think over a longer period of time. So if I had a look at the options chain, I can go all the way out to January 2024. What's that? Is that 3 years? How many years away is that? 2 years. 2 full years away. That might be a little bit more interesting, but obviously I've got to pay a bigger premium now. So it was $27 per share before. Now it's $39. So a lot bigger premium because it's a lot more time for this to be right. Okay, anyway, we'll do a quick. Let's say I wanted to buy that this 130. That's fine. I'm going to click on 130, and then I'm going to press the trade button over here. So let me just move the screen. Okay, so here we go. I'm trying to buy a call option. I'm buying one call option and I'm going to buy it at this price, $27.34. So I'm just going to place it as a market order. Whatever the market opens up at, I'd be happy with. Okay, good to cancel. Now, I'm not actually going to submit this order because I don't want this to actually go through, but I'll show you the preview. And it tells me I don't have enough cash. The reason is because I have to pay this premium immediately, $2,717. I have to pay this amount of money. And therefore I would be able to buy this call option. And I don't have enough available funds, so that's the problem at the moment, so I couldn't actually do this anyway, and that's fine. But there you go. If I did have the funds, I could press transmit order, and that would be it. That's how I would buy a call option.
Now, I want to say a quick thank you to David MM. Thanks for your comments and support here on the channel. I appreciate it a lot. You are a legend. Thanks for staying to the end, and I'll see you in the next video.